What Fred didn't say was that I was on the payroll before there was a payroll, because of the fact that we very much, I didn't have a lot of money at that time, and that's why I was on the payroll so early. But this book that we've done is, first of all, the question, why did we write it? Well, there are really three purposes. As Fred said, it's assessing the case for capital account controls, capital account opening, in the light of new developments. No, really, new developments in a series of areas. There's the work on the theory of it that's been done by Anton Korenek, mainly, which it needs to be factored in. There's new discussion under thinking in official circles, in particular in the IMF. And then there's a series of new crises that have occurred in recent years. So it's the conjunction of those three factors that we, in fact, aim to encompass in this this rethinking. We're proposing policy attitudes and more of a policy principles and proposals that we believe should stem from this, and that we believe the international community should adopt. There's no suggestion that we don't think that the committee G20 really went far enough in their what they call coherent proposals. They really didn't have any proposals for adopting, and we suggest certain proposals which we believe should be adopted. Now, the history of this subject, first of all, there was, in the days when Bretton Woods was being founded, Keynes was a clear advocate of capital controls. He thought that they were indeed necessary to the functioning of a modern economy. And White more or less went along with those views. I don't think White was ever as enthusiastic, but the IMF that emerged from their deliberations in the mid-1940s more or less accepted capital controls as part of the rules of the game. You weren't going to have a system that was going to give free rein to capital movements of the sort that were widely viewed at that time as having led to the downfall of the system in the 1930s. However, over the course of the next 20-something years, there was increase in capital mobility, and eventually this was such, there was $2 billion a day. That was a lot of money in those days, but that was what the Bundesbank was being flooded with in the later period of the Bretton Woods system, and it simply couldn't adopt that. So the Bretton Woods system broke down fundamentally because of capital mobility. There was then the Latin American debt crisis followed in the early 80s. And the Asian crisis followed in the mid-90s, and both of them were due to what Domingo Calvo described as sudden stop to capital inflows. And these were subject to, that was clearly the problem which led to both the Latin American debt crisis and the Asian crisis, and because of that some of us became very suspicious of capital movements. It happened again in Eastern Europe in the 2008-2009 crisis, where some of us, and the consequences were severe, but they were overcome. As Anders Asland has repeatedly pointed out, Estonia suffered a fall in GNP of 15% in 1 year, but they recovered. And they took the necessary measures and they faced up to the need to it. And so they recovered without devaluing. When you think about it, really the Eurozone crisis has the same, it has the same origin. There was big capital inflow going on from Northern Europe to Southern Europe, and then this came to a sudden stop in 2010. And that's what led to the Eurozone crisis that has been plaguing us ever since. So the history of the IMF, on the other hand, has never had a consistent policy towards capital movements. It tolerated them in the early days. It became increasingly hostile to capital movements in the later days, and leading up to the reform in 1997, this was a reform that was aborted because there was an attempt to reform the system, which wasn't in fact accepted by the membership. The G20 then, last year, the French announced that they were going to get the G20 to implement new policies towards capital flows. And the G20 at Cannes certainly displayed a willingness to envisage a regime, but quite honestly, I think it didn't manage to formulate one. So that's a proposal which is going to be presented by my colleagues in what follows. Thank you.
So I'm going to give you the main course of the presentation, and Arvind will give you the dessert. So if we look at capital account policies in the world, what do we see? We see a tremendous heterogeneity, a tremendous variety in emerging market economies. We see countries with an open capital account, free capital mobility, like Chile. We see countries that experiment with prudential capital controls, like Brazil now. And we see countries with a closed capital account like China. Obviously not completely closed. China receives a lot of FDI, but all the rest is very restricted. And there is here a dissymmetry, an asymmetry between trading assets and trading goods. Unlike for trade in goods, where there is a strong regime of international rules with the WTO, there is no discipline for capital account policies. This is left at the discretion of country authorities, with some regional exceptions, like in the European Union, or also the free trade agreements, bilateral free trade agreements between the US and other countries. So is this asymmetry a problem? Now, one view, and this is the defense of the status quo, is that it is not a problem because free trade in assets is much less beneficial than free trade in goods. Well, there is a lot of evidence on that. That opening your capital account is not very conducive to economic development or growth, much less than international trade integration. And if this is true, then, well, maybe the international community does not have a strong stake in promoting free capital mobility and can let countries do what they want. Now, we agree with the premise of this argument, but we disagree with the conclusion. So we agree with the premise because we take a look at the data, and there is a large literature on the impact of capital account liberalization and international financial integration on growth, and the papers are often difficult to compare. So in chapter 3 of the book, we do what we call a meta-regression. So we do all the regressions you can think of when you want to regress growth on some measure of international financial integration. You have something like 2,000 and a few hundred regressions, and then we count those that are significant. And our results are basically consistent with most of the literature. We don't find much of an effect except for FDI inflows and portfolio equity inflows. However, we argue that in spite of that, the international community should agree on a set of rules for capital account policies. And there are two reasons for that. First, encourage good policies and discourage bad ones. And the second reason is that those policies have international spillovers, and so they are a common concern. So first, the case for good policies, good capital controls. The fact is that we understand now much better the case for prudential capital controls. And obviously, since the crisis, there has been a lot of interest in macro-prudential policies and how to curb the boom-bust in credit and asset prices. And one can view prudential capital controls as just the open economy aspect of that. The objective is to curb the boom-bust cycle in capital flows, and the objective is to reduce overborrowing in the boom, overborrowing that comes from the fact that economic agents do not internalize the impact of their decisions to systemic risk. And there is a whole new literature, the new welfare economics of prudential controls, that tells us the desirable features that these controls should have, and typically they should take the form of a counter-cyclical tax on capital inflows, a tax that you increase when you have a boom in inflows, that you reduce when you have a bust, and a tax rate which is higher on dangerous forms of inflows, like short-term foreign currency debt, for example. So this is very reminiscent of what Brazil has been doing in the last 3 years. Obviously, there are problems with those controls. There can be circumvented, and we discuss that in the book. But at the end, we think that they are a legitimate tool in the macroprudential toolbox, and that they should be used along with other more domestic macroprudential instruments. From this perspective, a code of good practices, which could be developed, for example, under the auspices of the IMF, could have the advantage of reducing the stigma that still exists with the use of prudential capital controls. Now, the IMF itself has become more tolerant of prudential capital controls, but it is still a little bit on the side of presenting this as a last resort instrument that countries should use after everything else has been exhausted. And we don't see any good reason for that. We would view it just as a legitimate tool in the toolbox, as I said, not less legitimate than other instruments. Now, let me talk about the capital account restrictions that are not so good. Capital account policies defined in a broad way as reserve accumulation, controls on inflows, all the possible interventions, distortions introduced in capital flows by the public sector, capital account policies can be used to distort exchange rates and trade. So I'm illustrating that with this chart, which I like to think about, to think about China. So this is between 2000 and 2011, and you see in red the ratio of Chinese foreign exchange reserves to GDP. In blue, the ratio of domestic loans and portfolio investments by domestic banks as a ratio of GDP. And in black, the trade balance. So the red line and the blue lines are the two main components of the asset side of the consolidated banking system, right? So the banks plus the central bank, which are all more or less directly controlled by the government. So between the end of 2002 and the end of 2008, you see this large increase in reserves, which we all know, but associated, and that's the decrease in the blue line, associated with a decrease in domestic loans and portfolio. So essentially what was happening at the time is that the Chinese government, the Chinese public sector, was using the Chinese loanable funds to accumulate reserves, but at the cost of financing domestic spending in China. This is the decrease in the blue line. And you also see, after starting in 2009, the reversal in those policies. So reserves stop to increase in terms of GDP, and you have this lending stimulus in China. During the first period, you have a large increase in the trade balance, which essentially results from a forced saving induced by this policy, and it decreases starting in 2009. Now, the essential point is that I would like to emphasize is that this policy could work because the capital account was very restricted. It is one aspect of financial repression, which is of the essence of what was going on here. If the capital account had been open, then the Chinese private sector would have been able to undo the reserve accumulation by selling domestic assets. Or the US would have been able to offset the Chinese interventions by doing the kind of countervailing intervention that Fred Bergsten has proposed. But the capital account was closed. Now, it's not just about China. If you look at the correlation between a measure of real exchange rate undervaluation, so this is on the x-axis here, and a measure of capital account restrictions on the vertical axis, you see that the countries that are undervalued on the left tend also to be the countries that have a low Schindler index on this figure, meaning they have a restricted capital account, a more restricted capital account. So the thought that this leads us to is that, in fact, there is a link between capital account policies and trade. Capital account policies can be used to distort real exchange rates and so to distort trade flows. Now, how different are they from more standard protectionist instruments like tariff on imports or subsidy on exports? Well, actually, it's possible to show in a simple model that one can achieve exactly the same outcome with capital account policies as with tariffs and subsidies. So there is a practical implication from that, which is that if you want to ensure that there is a level playing field in international trade, then you might need to restrict not only the use of explicit protectionist policies, but also implicit protectionist policies taking the form of capital account policies undervaluing the real exchange rate. I think that's maybe the most original insight of the book, making this link between capital account policies and international trade. So based on that, what is the main proposal of the book? It is that the international community should adopt international norms for capital account policies in the same way as it does for trade. This could be done under the auspices of the IMF, but unlike in the debate about giving the IMF jurisdiction over the capital account in the 90s, the objective here would not be to promote free capital mobility, not necessarily. The goal would be to encourage good controls, and as I told you, there might be quite justifiable prudential controls, but discourage also the bad ones that have a distortive impact on trade, which is essentially analogous to the distortive impact of protectionist trade policies. We would favor transparent and price-based measures, so if possible taking the form of a tax on capital inflows, like in Brazil. There should be a ceiling on this tax, which would ensure that the potential distortion induced by the intervention is limited, and we propose a 15% ceiling. And obviously there would be caveats and exemptions. Obviously, it would be more important to apply this discipline to large countries that are strategic member country in the global trade system, and there could be exemptions for countries that have an underdeveloped financial system. So this is our proposal, and now I'm going to leave the floor to Arvind.
Thanks, Olivier. So I guess economists are very good at coming up with proposals. The question is, what is the political economy of it actually being realized? Is it kind of feasible? How can we think about, actually achieving this cooperation? And I think so. If you go through what the obstacles for cooperation for such a proposal might be, I think there are obstacles both at the level of principle and at the level of the substantive contents of what we're proposing. Now, it turns out, kind of funnily and ironically, that the principle of international regulation under the auspices, say, of the IMF is actually opposed by Brazil, certainly, and possibly by other emerging markets. It's ironic because, as Olivier said earlier, one of the reasons we might want this is because, there's a stigma attached to imposing these things, especially in a world of what I've called often the foreign finance fetish. We've had a finance fetish for many years, and the international counterpart is, the foreign finance fetish, which of course led to the IMF saying, in 1997 we must have free flows of capital. So in that atmosphere, if countries actually want to take decisions, actions, it becomes very difficult. And in fact, Brazil, in 2009, actually you could say implemented these policies with less than optimal vigor because of this stigma. And so something like a code like we're proposing would not just be to propose to advocate or regulate, but in some cases even legitimize and alleviate the stigma of attaching this. But I think part of this objection relates more broadly to the governance of the IMF, which I think Brazil and some emerging markets have, and that's something that needs to be, I guess, addressed. Now, the proposal where, the prudential taxes or inflows that we propose, obviously it's going to be opposed by the financial sector, and I think most importantly and most crucially, the aspect where we talk about, trying to get rid of the kinds of restrictions on capital flow of the sort that China has would obviously be opposed by China. So can we think of sticks and carrots? I mean, vis-a-vis China, I think, in the book we spell out some sticks and carrots. The sticks have taken the form, for example, Fred has a proposal where he says, the US should be able to, in some ways impose capital controls on Chinese flows as a way of, counteracting what they are doing by keeping out capital from abroad. Joe and Gary have a variant of that where they say perhaps the US should be able to tax the return on foreign assets as a way of penalizing Chinese investment in US Treasury bills and so on. In terms of carrots, one can think of granting market economy status for China, which it doesn't have. We can think about, say, revisiting investment rules, especially for sovereign wealth funds, because China is increasingly has an interest in having its doing FDI overseas, and it chafes sometimes at US rules that under the security garb, which they think are really kind of protectionist ways of keeping out Chinese investment. So one can think of a bunch of sticks and carrots to address this. I mean, this is not going to be easy because it's possible that China is beyond all sticks and carrots that people can offer. But I certainly think that this is a proposal that has some appeal, and which I think we should try and at least work, because at least we would say it's better than the status quo of having no regulation at all internationally. So I want to conclude by trying to draw this together and making some observations here. I think one of the reasons I think this regulation or a revisiting of this is long overdue is what I would say to correct the foreign finance fetish. One thing I should mention here is that the foreign finance fetish, of course, manifested itself multilaterally, but also the United States in its agreements with Singapore and Chile Now, Ted Truman will pounce on me, but I might say that those free trade agreements did overreach. I'm not quite sure that they prohibited imposing capital controls for macroprudential reasons, but they did take out a lot of degrees of freedom for these countries should they want to do that. And as Fred alluded to earlier, most recently there is some Democrats on the Hill want the U.S. to kind of make clear that those agreements don't in fact preclude the possibility of that these countries might want to take some of these actions for prudential reasons. The other point I would like to emphasize here is slightly kind of tangential maybe, and this is something that John said earlier. If you look at the most recent Eurozone crisis, I think in terms of analytics, we got two new insights about currency unions from this Eurozone crisis. The one is what Paul de Grauw has talked about self-fulfilling liquidity runs in the absence of a central bank. I don't want to go into that. But I think the other insight from this Eurozone crisis, which kind of bears upon our work, is the fact that in a currency zone, you could have endogenously generated shocks, endogenously generated asymmetric shocks, which in this case took the form of capital flows from surplus countries to deficit countries, leading to the huge capital in Spain and Ireland and so on, which then leads to the uncompetitiveness problem in part. So this was a kind of endogenously generated shock, and capital flows had a lot to do with this. Last 2 points, I think, what I think might be appealing about the book and the proposal is very much what Olivier said, that we make this link between capital flows and trade. And I think we make it in two ways. One is fundamentally the fact that now there is a total asymmetry between the regulation of trade flows, which are regulated, and the regulation of capital, which is completely absent. So I think we want to rectify that asymmetry. And I think a second asymmetry that we would try and rectify within that is that we're not only addressing the problem of too much inflows, which is kind of Brazil problem, but also the problem of too few inflows, which is the China problem. In the Brazilian case, too much inflows leads to overvaluation and creates all the attendant problems. In the case of China, you get the undervaluation problem and the externalities that exerts on competitor countries. Sorry, one small point I'd like to make, which is that in the case of the taxes on inflows that Brazil is imposing, there is in fact actually an externality which is now being highlighted by some work that Christian Forbes has done, which is that when Brazil imposes taxes on inflows, actually what investors do is then reallocate capital to other emerging market countries. So in that sense, Brazil imposing a tax on inflows might lead to too much inflows into, say, Chile or Argentina, and therefore exert a kind of problem, transfer the problem from Brazil to other emerging market countries. So that's again an externality which I think calls for international regulation at the international level. So I want to conclude just by saying that there's actually a very, John Maynard Keynes, when he was in his very protectionist phase, he once said that let goods be homespun as much as possible, but above all, let finance be national. So think of it this way. Even Keynes made a distinction between trade in goods and trade in capital, but in an overall protectionist context. He said, stop that even more, stop finance even more than stop trade. And what, in a sense, what we're doing is to preserve the same kind of marginal asymmetry at the international level, but with a general presumption that trade should be open and, as far as possible, finance as well. Thank you.